Uh, One perfect example is a guy named Paul Tudor Jones. You guys should be familiar. He runs one of the largest charity organizations in the world, Robin Hood Foundation. He's donated over $1.25 billion to charity. He's worth over $3 billion from his hedge fund, Tudor Investments. He's my kind of personal hero. And if you guys have been trading in the markets for a while, I hope you've read the book Market Wizards. And he's quoted in there and saying, the reason I attribute a lot of my own success is Elliott Wave. It allows you to create incredibly favorable risk reward opportunities. I actually have a video that is kind of a lost, stolen video of Tudor running his fund back in the 80s and using Elliott Wave. And like I said, he's one of the best guys out there. So that's a little bit about Elliott Wave. So that's what we're going to talk about. Again, that's me from CNBC days. I still do it every Friday. I'll be on this Friday. And a couple things we'll talk about here is Elliott Wave is it for everyone? 3 biggest complaints. I don't know where to start the count. There are too many rules and it's too subjective. If you've thought that before, you are not alone, and we will certainly hope to overcome that. Okay, so let's get rolling. First thing that I want to ask is which markets are you guys currently trading? And I'm going to launch a poll here. And if I just hit launch, you guys should see a poll come up on your screen. So go ahead and type that in if you don't mind, and I'll just kind of keep an eye on what's going on here, and I'll just be able to tailor the presentation based on that. So right now I'm seeing 60% stocks and ETFs, 44%, 45% FX, 33% options. Okay, so a good split between stocks and Forex. All right, good to know. That's perfect. The other one I want to look at here is those of you who are using Elliott Wave. I'm going to launch the next poll here and let me know where you are with Elliott. And again, this is going to help me this is going to help me tailor the presentation so you guys get the most use of it. What is your opinion of Elliott? Use it regularly and comfortable with it? I'm an occasional user and I know enough to be dangerous. I know very little, but I'm interested. I believe it's voodoo black magic. Okay. All right, interesting. The highest is I know very little, but I'm interested. Right below it is I use it occasionally, know enough to be dangerous. So 38%, and 23% I use it regularly and comfortable with it. 0% I believe it's voodoo black magic. Okay, that's very interesting. Okay, cool. All right, perfect. So with that being said, let's dive in. As we said, we started with intermarket analysis, and this is how we start the trading day. And especially on a big fundamental macro event like today, we want to know, which of the 4 major asset classes are trading with the other ones. What's correlated, what's not correlated, what can we look to happen if we're in a particularly traded market. I know half of you trade stocks and options and ETFs, and the other half are trading FX. So the good news is you can't trade one without the other. You have to know where all markets are going, the 4 major asset classes, because you could have the most perfect setup here on the dollar, but if you're not aware of what stocks, bonds, or the gold market or commodities are doing, your trade could be doomed even before you begin. So you got to know what the basic trends are of correlated markets. Okay, so looking back here, there's a couple different ways to do this. We are looking at gold in yellow. We're looking at the S&P here in white. It doesn't have a label. The base market doesn't have a label. That's something I might ask Tony to do in the future. Just put the base label in there. And then bond market here in blue and the dollar in green. So what I've done is taken a starting point. Okay, and there's a couple different ways you can do this with intermarket analysis. You can take a starting point where markets either made a significant turn or a major break, or you could do it from a significant date, the beginning of the month, the beginning of the year, beginning of the quarter, whatever it may be. Oh, sorry, guys. Let me just stop the poll. Close. Okay, perfect. So you guys should be able to see my screen once again. Thanks for that. Number 4. Okay, good to go. Guys, see the overlay screen now? Okay, perfect. So that's the way you do intermarket analysis. You either find a significant point in which the markets broke out, or there was a significant turning point in the markets, and then start your comparison from there. And what I've done is taken the MotiveWave feature of percent change chart. So if you go up here in the top left, there's a percent change option. Okay, so you can do your typical open high low close bars, or just high low close, or candlesticks, or Heikin Ashi, or whatever you want, line, anything you want. I love the percent change feature right here for intermarket analysis. And what you can do is just find, like I said, either a breakout point, a significant turning point in all major markets, and do a percent change from there. You've created a zero baseline. This is your basis of comparison. And then you can see how the markets have interacted with each other. If you don't go to a percent change chart, it's going to be kind of hard to really kind of determine the magnitude of a move relative to the other asset classes if you don't do a percent change chart. It's possible, but I think it's a little bit better this way. So I've just chosen the August breakout. Okay, it was very quiet into August, and then as soon as the halfway through August came, we saw gold market breaking down. So I'm just going to go through the analysis kind of live here. And the first thing I notice is look at the green and the yellow. Those two are mirror opposites. And something even cooler, which I can do, is if I click on the dollar, which is green, I hit inverted. Hopefully it will, there we go. I've inverted the dollar, basically made it the euro. And look, pretty good comparison right there. All right, those guys are right on top of each other. What that means, as this US dollar line is going down, the dollar's getting more expensive. Okay, so then we trade up together. And now I think this is a little bit of a divergence right here. When you get two correlated markets that are going in opposite directions, that's called an intermarket divergence. So you're seeing the dollar. Let me just remember, this is inverted. So as this chart is going higher, the dollar's going lower and gold is going lower. So right now, what we're seeing heading into the Fed today is we're seeing, and I just put it back on the right side, the dollar is down and gold is down. That's interesting. Okay, that's interesting. If you look at the bond market, which one would it relate to? Actually, I would say I'm seeing bonds and gold trade in the same direction. Gold makes a low here. The bond market in blue here have been rallying, but then gold makes a significant low and then rallies right alongside with the bond market. Bonds top off on that amazing move up that we saw on October 15th and 16th. Gold makes a little bit of a high later on, but then begins to sell off along with bonds. So the takeaway that we have so far is we're seeing, ever since October came, we're seeing gold and bonds trade together. So that's very good news. Okay, that's very helpful. Gold and bonds need to trade together. The dollar should be trading inversely to gold, which it is. But as I said, just in the last week, we've seen dollar sell off and gold sell off. We know from the correlation since since August, that's not sustainable. And then finally, we bring the stock market in. And the stock market, just doing a little bit of eyeballing here, I'm just kind of looking at as I follow my cursor around here, where is this stock market reacting to? And I think the best one is opposite of the bonds, right? So stocks here in white top out, bonds bottom. Bonds rally, stocks sell off. Bonds and stocks reverse in the exact same day. Bonds sell off, stocks have rallied all the way back. One thing that I think is interesting is that, okay, take a look at the white line. The S&P is right just a stone's throw away from that September 19th high. Okay. But let's do that same analysis against bonds. Bonds are nowhere near that September 19th low. So bonds, okay, are acting very strong. And this is one of the charts I really want to look at. Okay. So let's just kind of recap that. All right. Let's just recap that. So the key relationships that we have for today, let me just bring up a Word doc here. So we said, and I mean, this is how I kind of prepare my day. Gold. don't think you guys care about implied volatility. Gold is trading inversely to US dollar, but both trading together in the last week. That's number one. Stocks, bonds, and I'm looking at the 30-year bond here, are trading inversely, but the bond market is nowhere near the SEP 19th lows, whereas stocks are very close to the SEP 19th high. Takeaway, bonds much stronger than they should be. And this is key heading into today's FOMC, which I'll tell you about. The other relationship here, guys, what else did we say? Gold and dollar, stocks and bonds, and gold and bonds trading together. That was the other key takeaway. Gold bonds are trading with a, we'll call it a loose direct correlation. Okay, so those are the IMA takeaways heading into the Fed today. IMA takeaways. So what exactly does this have to do with the Fed today? Well, the Fed is going to wind down a very historic bond buying program known as QE. Okay, CNBC did a funny little story. It's the end of QE as we know it, and the markets feel fine, to that old REM song. I'd sing it for you, but I'm a horrible singer. Okay, so it's the end of QE. So what does that mean? So what they're doing is they're widely expected to announce on Wednesday the end of its latest bond buying program known as QE. All right. Fed officials say purchases serve to strengthen job growth and economic recovery, no longer needs quite so much central bank support. So, guys, what they're doing, just so you understand, is they are, for a lot of years, they have been buying bonds. Okay. And bonds, okay, as bonds have been bought up, the corresponding interest rate or yield has been driven down. And if yields and interest rates have been driven down, the amount of money that people can make with investments, fixed investments, is significantly reduced. So what that does is, with low yields and you can't make any money other than in the stock market, what the Fed is doing is forcing people into stocks to make a return. What that does is screw the older person who is living on a fixed income from their interest payments, IPs, okay, because they're making nothing, so they're being forced into the stock market. Thanks. That's very nice of you. Take a much more risky investment than you should take in your 60s and 70s. Thanks, Fed. But what it does is, by taking interest rates lower, it also forces businesses to take money out of their bank account and invest it into equipment and into the economy. Okay. My handwriting's bad, but it's not quite that bad with this thing. So what they've been doing is taking bonds up, buying long-term U.S. Treasuries and even short and medium-term U.S. Treasuries, buying mortgage securities to force those interest rates down. Those interest rates down are taking and forcing people into the stock market, and it's taking corporations to take money out of their bank account and put it into the economy because they can't make any money with these low interest rates. So the argument is now, well, the Fed is going to stop buying bonds. Okay, they're going to stop buying bonds, which is going to stop forcing the interest rates down. So the question now today is what's going to happen? They're saying that the market that has this massive market rally has been precipitated by the Fed doing this quantitative easing, these bond purchases. So they're saying the market that lives by QE, lives by the Fed, are they going to die by the Fed? What's going to happen when we're finally out? The fact of the matter is, guys, there's still $4 trillion. The Fed is still long $4.5 trillion of bonds. And what they've done is they've taken bonds into the Fed. They're holding those bonds and they put that money out into the system. Okay, so there's still 4.5 trillion sloshing around the economy. The question is not when they're done buying bonds. Okay, that's a big deal. But the question is, when are they going to start taking some of this money back out of the system and putting it back in their bank accounts? And that's going to be the next big focus, is when people are going to start expecting that. And that's when I think stocks are really going to get hit. So the key today is to watch what happens to the bond market. If bonds act strongly today on the basis that the Fed is done buying these bonds, then I think the uptrend in bonds continues, and I think that's where our Elliott wave story should start. Okay, so let me just slide over here. And Herman, yeah, dollar yen definitely opposite of gold. Dollar is trading opposite of gold for sure. Yen and gold have a direct correlation, so that makes perfect sense. So let's go to bonds. Right now they're down 0.2%, and I've been looking actually for a low in bonds, and I'm trying to get long the bond market, but I need a good reason to do so. The fundamental reason, what's going on here with the economy, or what's going on with the reaction to the Fed. If stocks were to sell off today in anticipation of the Fed withdrawing liquidity, withdrawing those bond purchases, then I'd love to be long bonds. But if stocks are going to continue to move higher, bonds should be going lower. So this is a very basic count. This is a very, very basic chart, actually, with no real Elliott wave on it. I have it in the alternate chart that I'll show you in a second here. But this is just a very basic chart. From September all the way up to October 15th, we've seen a massive, massive move. This was a historic move higher in bonds. This move wasn't even as large as September 11th, 2001, the move in bonds. That was a massive move. So you got to think that kind of movement is going to at least warrant a reaction back higher. So my tendency is to want to be long the bond market. And you say, okay, well, Todd, I don't trade bonds. All right, no problem. So what you do is you go right-click Instrument Overlay and just go TLT. Okay, that's the bond ETF. It's a mix between the 10 and 30-year U.S. bond. So as we put TLT in, here's a little trick for you. I'll just wait for this to come in here. You can overlay where TLT is on top of 30-year bonds. Okay, TLT is your exchange traded fund for the bond market. And what you got to do is kind of line it up so the blue line is inside of the white. It's not going to be perfect, but it's going to be pretty close. Okay, there we go. Not bad. And you can see that, if we pull back to this old high, which in the bond market's about 140.5, which equivalent in TLT is about 119. You're also going to notice it's a 618 retracement of this move down. Okay, let's do this in a little bit more of a high-tech fashion. I'm just going to hit my hotkeys and just bring up the corrective tool, A, B, and C, and it drops it up there higher for me. Okay, so I want to know the typical relationships of a B wave and A wave, and there they are. Blue is your shallow level, green is your ideal. So we're down right around the 140.5 in bonds to about 119 in TLT. So that, I think, is going to be a very important price. I like to do price, but I also like to do times. Let's do a time comparison of B and A. Okay, and now here's where things get really awesome. I'm going to get rid of these down here. If we are doing a price comparison of A wave compared to B wave, why not do a time comparison of A wave compared to B wave? If A wave lasted, and I know there's a trick on here, and I'm sure Tony could tell me how to do this. Show info. If there's a time elapsed, I know there's a trick on MotiveWave, and Tony would tell me how to do it. That's okay. Let's say that A wave lasted from September 19th to October 15th. Let's say it lasted 30 days. Okay. Take 61% of 30 days, and that would be right at the 618 here on October 30th, which is tomorrow. So basically what we're saying here is there's a wonderful, beautiful agreement between 61% price as well as 61.8% time retracement. That is tomorrow at about 140 and a half here in bonds, which is about 119, 118.75. So that's a very, very critical point in bonds. Plus, guys, it's the old high. Okay, it's the old high here from August. So I am very interested in this level to buy bonds. Okay, and so what I'm going to do ahead of the Fed is go back to my sheet and say, okay, IMA. And this is how I set up my trading day. This is how I do it with clients. MotiveWave setups. Okay. US 30-year bonds pulling back to 0.618 B versus A, time and price retracement at 140 and let's call it 15-30 seconds, which is equal to 118.75 in TLT. If we, and it's also that August high and also August high, right? Key support. So turning back to the work we did, if bond markets are going to find support here, what must we see from an intermarket point of view? Looking back at what we've done, let's see what we've done. Stocks, bonds are trading inversely, but the bond market is nowhere near the September 19th lows, whereas stocks are very close to the September 19th. That would be the high. So right here, from an intermarket point of view, we mentioned that bonds are nowhere near the lows from the 19th, where stocks are quite close to the highs from the 19th, and they're inversely correlated. That's telling you the bond market is stronger right now, and it's not confirming what stocks are doing. So if stocks were to roll over, which means go down, look right to the long side of bonds. So now we have a plan. Okay, so we'll do some analysis on the S&P, and I also want to pull the dollar into this. All right. Now we also know that gold and bonds are trading with a loose direct correlation. So in order to confirm that trade, we would also want to see gold moving higher. Okay, so that's trade idea number one there. All right, so that's that, gold, bonds. Now, let's take a look at the S&P. So that's bonds. So we have 15 minutes to go until the New York Open. Futures are flat. Futures are down negative 0.01%. NASDAQ down 0.1%, which is nothing. Not getting a quote on Russell futures there. That should pop in there hopefully soon. Gold is down 0.5%. Interesting. Crude is up a bit. Nikkei was up 1%. Dollar's flat. Okay, so now let's go into the dollar. The dollar, and I'll do the wave count quickly for you. I know this from memory. The dollar is in a fourth wave correction coming from the May 7th low. So I'm just going to, actually, I'll bring it over here from the control panel. I'm going to go, oops, I don't know why that happens. Dollar index. Let me bring that dollar back. There we go. Go over here to MotiveWave and then go to Impulse. Okay, the dollar's in a nice, beautiful uptrend. Thing is, we're in, I think, a fourth wave correction. All right, so what you'll do is say, okay, wave 4 is here, wave 3 top is there, wave 2 is here, and wave 1 is there, and 0. And then you say to yourself, Todd, how do you know that? Well, guys, anytime you see a beautiful, huge, massive breakout wave, which was preceded by a correction that didn't make a new low, it's probably a third wave. Really, you don't really need to know what's happened to the left of this chart and over. It's very simple. If you see a big breakout wave, which is preceded by a correction that did not break the prior low, you're probably in a third wave rally. Okay, so we have another fifth wave move to go. So we still like the dollar higher. All right, so now let's do some of our typical fib relationships. Ratio analysis, first thing you want to do is I want to confirm that's the case by going ratio analysis 3v1. I want to look at the distance traveled in wave 3 compared to the distance traveled in wave 1. This was a massive move. We got through the 2.618. That's a huge, huge move. Okay, and you might say to yourself, well, could we make any of these waves 3, 4, and 5? No, because you need to have something that's equal in price and time compared to the prior wave 2. There's no correction in here that is equal to price and time as wave 2. Okay, so in order to find the end of wave 4, there's a few studies I want to do. I want to do ratio analysis for V2. So what we're doing is price distance traveled in wave 2 compared to price distance traveled in wave 4. Okay, we're looking for equality and we're looking for 1.618. Okay, we'll leave 200% on there. That's fine. Okay, so we're through the equality point in terms of price distance. We got down right to the 1.618 and we bounced. So that's interesting. So next thing we want to do is not only do wave 4 in price compared to 2, we want to do wave 4 compared to 2 in time. So we do time analysis 4v2. All right, and you're looking for the green and orange levels. All right, so let's find equality. Now, what's interesting is equality is today, 100%. I don't think that wave 4 is over. Okay, I think we're going to get out to the 161 or possibly 200% time relationship. So that means this wave 4 has to have time to breathe. Okay, the price could be, the low could be in because we've got down to the orange level, but we need to get out to these later dates, which would be November 9th and November 15th. So wave 4s can be tricky, and wave 4s are tricky. You got to let them breathe. You got to let them do whatever they want. So what I'll do is just loosely put a 3-wave move in A, and then we'll just put a B wave here. Basically what we're doing is we're kind of sectioning off an area in which the 4th wave can exist. And let me just do this. Okay, so let me change the colors. Let's go format something. How about yellow is good. So we know that wave 4 should complete at least at the 100% time relationship, which is right there. Okay, and we could get out to the 2618, which is going to be right here. And then we really shouldn't, okay, that's fine. We'll just leave it right there. So this is the ending zone for wave C of 4. And if we're going to go higher in B, we should at some point get another sell-off in the dollar. Okay, so we have a B wave, and the question is B there, or are we going to have one more little push higher in B, which is going to look like that? Point is here, guys, I think we're going to get another decline down in C of 4. Okay, that will take us out to November 9th or possibly November 16th. So if we see a little strength here in the dollar, I think it's sellable today. I think it's very sellable. All right, for a decline. Now, I'm leading over to your point, Herman, and I saw your comment earlier. Okay, remember, if we do this, if we were to add dollar yen or the FXY, oops, USD JPY, if we were to add dollar yen, you're obviously going to see dollar yen and the US dollar very correlated because we have the dollar in the first position and the yen in the second position. Okay, so dollar yen, I think, is setting up for a short alongside with the US dollar. Okay, alongside with the US dollar. Now I want to see something really wild. I'm going to try to, come here. I'm going to get rid of auto scale. Watch this. Actually, I'm not going to confuse you yet. I'm not going to confuse you yet. Let me do it on a different chart. I think dollar yen is going to have another push lower. All right. And I'll do the Elliott wave on dollar yen, but let's go back to some intermarket analysis. This is the next part of intermarket analysis that I wanted to go over. Quote sheet. No, not quote sheet. I want to do a new chart window. File, new chart window. Okay. Now, dollar yen has a very important relationship with bonds, which we've already worked on. So let's go to dollar yen. Okay. Ooh, and I already have it lined up. Okay. Dollar yen trades opposite of bonds. I won't get into too much reason why. It's pretty advanced, but basically as bonds are selling off, which this is inverted, so that's not right. Okay, inverted, update, there we go. All right, there we go. So we're seeing bonds and dollar yen kind of trade together. Okay, so let's see here. Is that gonna be right? Yeah, dollar yen, 108. Yep. So we're seeing bonds and dollar yen trade together. It's not the greatest correlation that I've seen. I've actually seen much better than that. Now let's add the S&P, add study instrument overlay. Yes. Let's just see how these three trade together. Okay. So we have the S&P in purple and bonds in green. We know these two are trading pretty well against each other. And then if we slide it down into dollar yen, how are these guys trading? Okay, and just look at this. And you got to get your art hat out here. You know, that little art hat with the little beanie thing on top. You got to be a little artistic here and kind of train your eyes to look at this and say, what's going on? Well, I see stocks and dollar yen trading fairly well together. And I see bonds trading inversely to dollar yen. Okay, if dollar yen and bonds are trading together, or sorry, dollar yen and stocks are trading together, right here, a little bit of inverse right here, but we lined up here. If you see dollar yen and stocks trading together, that means that dollar yen and bonds are trading opposite, which they are. Okay, so if bonds are going to find a low, and this is where you pull it all together here, guys. If bonds are going to find a low and begin to move higher, okay, bonds higher against that 148 level. That's too dark. Color, how about go down to white? Then dollar yen should begin to do that, which means the S&P, let me get color, how about I think magenta, which means the S&P should do that. Okay, so that's the relationship I'm looking for here today following the Fed. I want to do a little bit of analysis on the dollar yen before we go, which actually I already did, so we'll do that. Okay, stocks up. So that is the relationship we're looking at. Let's take a look at, before we go, SPX. Let's take a look at the S&P. Very kind of interesting level here. I believe we're in what they call an X-wave rally. Yesterday's move was really strong. We got through the 786 retracement of the decline from September 19th. Okay, it's at 1976. Futures are down just a touch here pre-market. I am going to be shocked if the S&P just continues to sail through this level without selling off a little bit down in the Y wave. Okay, I think we are in a fourth wave correction in the S&P. It can end, this X wave can end here. It can end at the high 2019. I see resistance up here into the S&P, which sets up a sell-off down in wave 4. And remember, if the S&P is going to sell off, bonds are going to rally from our 140.5 level that we looked at. And also dollar yen, as we said, should be in for a sell-off that is, this isn't my FX workspace, and this is the FXY, Control K. And here's what I like about this trade. Notice how stocks are up at the highs, like past the 786 retracement. Dollar yen is only at the 618. Okay, so it's not as strong as stocks are. basically the stock market is ignoring what dollar yen is saying. It's ignoring what bonds are saying. Okay, so if we get any kind of hesitation in stocks, I want to be long bonds. I want to be short dollar yen. And as I showed you, dollar yen moving down corresponds to bond markets moving higher. Here's the FXY, which is your ETF. If you don't trade the spot market, basically it's a short in FXY at 90 for a push. Oh, sorry, I have it inverted. It's not going to overlay perfectly with dollar yen. It's going to be inverse FXY. So basically, what I'm doing in FXY is dollar yen is going to move down. FXY is going to strengthen. And let me give you the level. This is an options trade I'm looking to put on. So if dollar yen goes down, FXY goes from about 90 to about 93. So a 90, 93 call spread in FXY is a trade I'm looking to put on. Okay. Okay, guys. Sorry for. I'll stay with you guys here through the couple of minutes, but I got a few questions. But I wanted to get that through. Now I know that was a lot of analysis, but that's what we're looking for. Okay, Todd, for level 5 target and E-wave, do you add the low of 1 to low of 4 to get 5 target angel observation once you see a low of 4 or 5 target? What about time projections? Thank you for general observations. Okay, hold on. For a level 5 target, I'm assuming you mean wave 5 target and E-wave, do you add the low of and then the market opens? What about time projection? Charles, it's just too. I don't understand what your question. Are you talking about triangle E? Let me know what you're saying there. What time projections for 5 based on wave 1 and 4? Yeah, I have time. I absolutely do time projections of wave 5 based on 1 through 3 projected up from 4. So yeah, I do that. Too much. Charles, yeah, absolutely. Intraday trading, sure. For MotiveWave. Charles, too many questions. We're gonna do this next week. If everyone was happy with it, we'll do this next week. It sounds like I have a lot of questions to answer for you, but I'm happy to answer all of them. Charles, do we use MotiveWave for intraday trading? Absolutely. Yeah, let's just see. S&P's up 1/100th of 1%. So just flat, flat, flat. So what I do is I have MotiveWave stretched across 6 monitors. So I was showing you the daily. So here's my 3 hour, here's my 1 hour. So let me just slide over the 1 hour chart here. And my little wheel is spinning. There we go. Okay. So there's the hourly for the S&P. So we're looking at W. Let me just hide that below, up in X. So like I said, I would not be surprised to see a little bit of a rollover here from the 2000 level. So that's the intraday of the SPX. Yeah, it's pretty awesome stuff. So if you guys want more information, MotiveWave.com, tradinganalysis.com. And I think we're going to try to do these every Wednesday. So you guys will get information for it. There's the MotiveWave webinar on my site. And then Tony can be found at MotiveWave.com. So, there's a lot of macro stuff, guys, because today's a big Fed day. So in the future, we'll do individual stock setups and stuff like that. So, there's a lot of macro kind of stocks and bonds and currencies and stuff like that. So, yeah, thanks very much. Appreciate that. You always seem to manually place labels. No, Russ, I'll use the auto. I don't manually do stuff, but for instance. Let me see here. I'll do this. I can just delete. Here's an A wave count in the S&P. I can just delete this. Watch. Delete it. And then let's see what the software. I remember what the wave count is. If I just right click decompose, I can do 2 levels. Let's see what it comes up with. That's very close to what I would do. I had something a little bit different. 1, 2, 3, 4, and then 1, 2, 3, 4, 5. I had something a little bit different. I had this. I did 1, 2, and then I did an extended 5th here in, actually, I don't remember what I did now. I'm just hitting undo. Oh yeah, this is what I did. I did 1, 2, and then this is a little suspect here, this wave 1. It looks like a 3-wave move. So it doesn't really change anything. We still had wave 4 here and looking to end up in wave 5. But no, I'll use the automatic decompose sometimes, but I like to kind of put my own count on top of it and adjust things a little bit. But yeah, I use the automatic decompose. There's another one you can do. You can just do a complete automatic wave count. So if you just go like this, just bring up a fresh chart and the S&P, let me get rid of that, dollar, bonds, make it a, let's open high, low, close. And if you just go Control Shift W, you can do an entire wave count on its own. Yep. So it just did an ABC for me off the lows. And then what you can do is just kind of go like this, decompose 2 levels, and it does the wave count for you automatically. So it's super awesome. For those of you who are new to Elliott, it's a great way to kind of get your feet wet and start practicing. So yeah, you use the automatic. I show 1 and 2 step high. Just want to let you know that Euros is blazing. Now, thanks. I'll let you know that the Euro Aussie sell trade you guys gave is blazing. Thanks, Septime. Charles, yeah, you make E-Wave understandable and crystal clear. Amazing to see the beauty of Elliott Wave motion. Wow, that was a beautiful testimonial. Thanks, Charles. But come back next week. We'll do a lot more of these. So, guys, I'm going to focus on the stock markets and should be fun. So, take those, have those takeaways. That I wrote out and see if they play out. The most important thing is on such a volatile day and any day, it's important to have a plan, know the relationships, know what the Elliott Wave setups are, have a plan going in. And if the market sets up based on your plan, you're free to act, being clear and calm and decisive and trading with controlled aggression. If you're trying to figure out all this stuff as markets are going wild post-Fed, good luck. You got to do it when it's quiet and you got to have a plan coming in. And that's why the motto of this company is plan your trade, trade your plan. All right, guys. So see you next week. Hope you enjoyed it. And we'll email you out the archive. So thanks, guys.